welcome to another roller coaster ride as we get through COVID. Cathy Sabater, mortgage planner and proud veteran. Wanted to talk to you today about what is an interest rate and how it's affected. Because everybody's always like, what's my rate going to be? Well, there's a lot of things we have to understand in order to get to that spot. So stocks are higher today and mortgage bonds are lower because there was an extremely low jobs report. So if you've been watching the videos, you understand that there's certain things that happen in the market that affect the decisions of investors. So BLS is the Bureau of Labor Statistics, and they're stating that the unemployment rate by industry, this is what was hit the hardest. Leisure and hospitality, they're at 35% unemployment. Last year was 5%. Wholesale and retail, 15.1, it was 4.2. Transportation, 14%. Construction, 12. Manufacturing, 11. Education, 10. So all of these were in low digits. So as we all know that we're in this pandemic, these are the industries that have been hit the most. So hopefully we will get that stimulus plan, right? Because the goal is to keep the economy going and to keep our families safe as well. So let's talk about interest rates and what the 10-year Treasury bond and how it works together, okay? So the 10-year Treasury bond pays out interest every 6 months, and the principal is paid out when the bond matures. So if it's a 10-year bond, you know it's going to mature in 10 years, right? In the meanwhile, every 6 months, you're getting a principal payment. Well, it's sold by the U.S. government and is backed by the Treasury. So today, the U.S. Treasury closed at 0.97, and it's about 0.799% lower than it was last year. Last year was 1.77. So the 10-year does not directly affect mortgages, but there is some sort of correlation because mortgage interest rates are almost 1% lower than they were last year. So what is an interest rate? Well, the interest rate is the cost of what? Borrowing money. So if you're borrowing money, it's going to have somebody has to pay and someone's going to earn some income. So the interest does provide compensation based on the risk. So when you hear the rates that are out there, it all is going to encompass on who you are and your particular scenario, along with what's going on with the marketplace. So interest rates are also a factor of supply and demand of credit. What does that mean? As you know, the Feds have been buying mortgage-backed securities every day to maintain the low interest rates, right? Because who else is going to invest in them? I don't know, but I'm glad they are. Why? Because the more they invest in the mortgage-backed securities, I'll talk about what those really are, then that means the banks have more money to lend. And if there's more money to lend, then it's cheaper. Think about now. We have all these buyers who want to buy the house, so there's a lot of demand, but in that instance, interest rates are going down, right? Because the demand has to do with supply. So if there's less inventory, less supply, that means it goes up. Right now, credit is so cheap, which means there's a lot of supply. That means it's drawing the interest rates lower. But that's with the government helping with paying these mortgage-backed securities. So the mortgage-backed securities are this. I work for a direct lender, right? And what we do is we use our money to fund and close your loan. Well, we can only manage closing so many loans before we have to say, hey, I need more money to lend more money out. So then what would they do? They package all this up and they package it into mortgage-backed securities, and then they sell them out. When they sell them, then this allows the bank to open up their capital, which means now they have more money to give out as far as credit is concerned, and hopefully maintain this balance to keep the rates as low as possible. Now, the interest rates are also different depending on the type of loan that you have. So, and your credit, right? So what's the risk if you have a 800 credit score, a 700 credit score, 600 credit score, okay? And then the tax consideration, and then we have to find out how can they take these loans that they're going to package up and convert them if that be the case. Because believe it or not, there are people out there still doing 10-year interest-only loans or 10-year loans or 30-year loans that are due or going to change in 10 years. So Believe it or not, there's a lot of different flexibility in regard to that. I'd love to have a conversation with you because that does segue into what happened in 2008. So let's just take a look at the charts real quick and see that the mortgage bonds are down. They're at 103.2. The S&P is up, and the 10-year, as mentioned before, is at the 9.7, 097. This is where, right, we fluctuated up, and then we managed to, hey, listen, are you going to lock or are you going to float, right? So when you purchase, remember, you only have so much time to get things done. And in refinances, you have time to float depending on your time frame, okay? So any questions or concerns, give me a call, 619-846-2675. Stay safe.